The European Central Bank raised interest rates by 25 basis points on Thursday, probably for the last time in this tightening cycle. It was deemed a dovish hike by the markets. It was always going to be that or a hawkish hold in terms of wanting to allow for one more 25 basis point rate hike over the coming month. But the ECB instead have decided to effectively get it out the way. We had new economic forecasts and that allowed for that last rate hike. But it was quite clear from the language from the central bank and from Christine Lagarde in the press conference after that while there is still the possibility of a rate hike at one of the future meetings, they're never going to close the door to that, especially given the uncertain environment. It's their view that the current tightness that they have created with all of these rate hikes over the course of the last year should be adequate to get inflation back to 2%, which is ultimately the central bank's goal. And the market seem to be now pricing that quite strongly as well. As we can see, the markets are pricing in around a 20% chance of another rate hike over the course of the next few months. So clearly don't deem that as a likely outcome. Inflation has been falling for some time, and that is being now reflected in interest rate expectations. The other thing that I think is interesting from this probability chart is that markets are pricing in a strong chance of a rate cut in the second quarter of next year. So they clearly don't view the tightening that we've seen from the ECB to be very sustainable for very long. That could be because they think that inflation is making strong progress and therefore it won't be needed to remain at the terminal rate for very long. You can start seeing interest rate cuts from the second quarter of next year. It could also be a reflection of the economy. We know the economy is struggling. Germany in particular has struggled. It's already been in recession and could fall into recession again quite soon if it isn't already. So maybe the economic woes are also factoring into those interest rate expectations, the view that they don't need to be high ultimately for much longer. We're not going to get that type of commentary from the ECB. I'd be amazed if we do even see them acknowledge the possibility of a rate cut before the turn of the year. They're going to want to be absolutely certain that they are going to, they are done tightening, that they have dealt with inflation before even considering cutting interest rates. And as I've said with other central banks, I do believe the ECB is very much in the same boat, that they are going to acknowledge the possibility of a rate cut very late in the day. They don't want to do any unnecessary loosening of financial conditions until they absolutely have to. That's why they've maintained such a hawkish stance up until this point, and will continue to talk about possibilities of rate hikes rather than rate cuts until they absolutely last minute. In terms of what that meant for the currency, you can see that the euro fell quite hard yesterday. And I think it was a combination of the fact that we did see a rate cut, as well as the fact that we did see the acknowledgement that there's every chance that this could be the last. I think many people didn't quite expect Lagarde and the central bank to be quite so explicit. She did allow, like I say, she left the door open to another hike, possibly, but they did make it quite clear that they are now of the view that they are probably done. And I think that was the important takeaway. And that's really what drove the euro lower. You can see here against the US dollar that we saw it move lower. What was interesting going into the meeting, I think, though, was where this pair was positioned, because you could see it broke below the 200-233 day simple moving average band. It didn't really accelerate lower, so maybe some apprehension going into that meeting, as well as a few pieces of data from the US as well, the US inflation data earlier this week, for example. But it moved below this moving average band before the meeting occurred, and kind of lingered in and around there going into the announcement and the press conference. So I think that really signaled that there was a bearish bias going into this, the expectation that there was a chance of a dovish position coming from the central bank, and that's what we got. The other interesting thing here is how we've rotated over the last couple of days. So we've not just rotated off around the bottom of that 200-233 day simple moving average band in a bearish manner, but also the previous low. So you can see the low from that last fib. So we had a shallow retracement to the 38.2 fib. Then we've broken below the fib low, and then we've rotated off it from below. So that's, I think, that bearish confirmation on top of the bearish confirmation of the break of the 200 233 day simple moving average band really is a bearish signal for this currency pair. In terms of what the key levels are now, the next one that really stands out, of course, is where we're seeing support now around 106.50. You can see that was the support in late May and early June. So that's the one that really stands out for me. And then below there, 105. 105, interestingly, has historically been quite an interesting level of support and resistance. And I think one of the reasons is the psychological element. I think whenever we trade at around 105, there's always a lot of speculation about parity in this pair. So I expect, and I think you should expect, we should hear a lot more now about people asking about parity. Are we going to see parity in the euro dollar pair? And I think that kind of fuels a lot of maybe apprehension and a little bit of tension in the pair as well. So it's going to be interesting once we get towards 105 if we do start hearing that a lot more, and if that affects how the currency ultimately trades, or if we are just going to continue to see it pick up that momentum. What is interesting on that momentum side, though, is that MACD moving average is still slightly trending lower, but the MACD histogram is very much not. So we're seeing that divergence, maybe early signs of that starting to form on approach to that 105 level. So that could be an interesting thing to watch. If we see the moving average bands on the MACD, as well as the stochastic charts show divergence as well on approach to 105, that could suggest we're seeing a bit of an exhaustion of the sell-off from late July going into what is historically been a very interesting area of support for this currency pair, and a big psychological level potentially as well. So a few things to still keep an eye on. Ultimately, the central banks are going to drive it. We're going to hear from the Federal Reserve next week and see if they deem the end of the tightening cycle to have already occurred. I'm still of the view that there's no more rate hikes to come from the Federal Reserve and now also the ECB. But if we can see that hawkishness, any hawkishness from the Federal Reserve, or which could potentially support the dollar, that could continue to drive this pair a little bit lower. It will ultimately depend on the language. So still plenty more to focus on, still plenty more drivers to come. A lot more focus again now on the economic data. I think the topic of conversation is going to move from tightening to when will we start to see rate cuts. And I think we're already seeing that the signs of that happening after the final rate hike from the ECB yesterday. But that's ultimately going to be the key drivers. There's still plenty more to focus on as this pair continues to move back towards what has historically been a big psychological level and a big technical level of support.